Good morning. I love the energy. Thanks for being here today. And so we are talking about small balance PACE. And I just wanted to start us off and kind of set the stage. I think Mary did a great job and was very energizing today. And today I heard her say small PACEs. What did she say? 50,000 to 250? But we're gonna poll you and see what you think in just a moment. But progress isn't just a right turn. It's a series of turns that we choose to take intentionally. And in our industry, our biggest opportunity is staring us right in our face. And that's what we're going to talk about with this esteemed panel today, is about small and mid-sized PACE deals and how to scale them. And so first, just want to get an understanding of who is in the audience today. So going back to that question of what do you consider small PACE deals? How about raise your hand if it's under 250,000? Under, do you think it's even lower? Under 500,000? Under $1 million? Under 500 million? All right. How about 50,000 to 250? Go back to that Mary's deal. All right. All right, so we have a wide range of answers. Thanks for participating. And then I guess just also as we're talking, getting prepared for this discussion today, we talked about, we always hear that small PACE deals are harder. And from your perspective, is that true from your experience? Do you think small PACE deals are harder? That could be even from administratively, or they don't pay out. It could be from whatever context you're bringing today. Are they harder? Yes or no? So some yeses, but not everyone's on board with that. Great. So I will introduce myself very briefly and then let these fine people introduce themselves and we'll get going. We did want this to be a participatory session. We have a few mics. Feel free to raise your hand and ask a question. We'll also save some for at the end. And so my name's Holly Houston. I am from Minnesota. Many people already have told me today they know from my accent that I don't think I have, that I am from Minnesota. And Minnesota, we've closed 485 projects. And of that 485, 80% is under $1 million. So Minnesota is special. We do close small PACE deals. But we have a revolving loan fund that isn't replicable across the country. That's really made us stand out. And so this panel here today is going to give us some great discussion and ideas on how we can scale it across the country and continue to serve the smaller PACE deals. So I'll turn it over to Colleen.
Absolutely. Hello, everybody. My name is Colleen Bucher, and I am with Amalgamated Bank. We do have over a $1.2 billion portfolio, all told between both resi and commercial PACE. So been at it for many, many years. I joined the bank in October 2024 from a different commercial bank that was also in CPACE. And we are America's socially responsible bank. We believe in doing well by doing good. And everything we do is mission focused and impact focused, and CPACE goes right to the heart of that. So we are actually based here in 7th in Chelsea in New York is headquarters, but I sit in DC, 1825 K Street, and we love small balance CPACE as well. Good to be here.
Good morning. I'm Paul Hoffman, Senior Vice President of Citizens Business Bank. We're California footprint. We're publicly traded. I run the CPACE division for the bank. I self-source and I also support 200 salespeople enterprise-wide. So we get a ton of inquiries and we have to be pretty quick in order to, fish or cut bait. And I'll get into that more later. And really, it depends on where you think small balance sits. What's that baseline for you personally? So we'd like to get into that today. Thank you.
My name is Colin Bishop. I'm the CEO of FastPace and Electrify. 4 years ago, I was the executive director of Pace Nation, and I could see something in the market data in Minnesota that prompted me to quit that job and create a platform that would replicate the success in Minnesota nationally, so that essentially that kind of infrastructure that would enable every bank, credit union, CDFI, life company that wanted to enter the market, but for whom it didn't make sense to like build an entire team to navigate the differences from one program to the next to be transacting CPACE. So that's what we do. I will just add one sort of market feedback note. DBRS defines small balance CPACE according to the docs and the work that we've done with them as everything under 7 million. But that is inclusive of $50,000 projects as well. But excited to be here and frankly overjoyed to see a full room. Thank you all.
Awesome. Thank you. We'll get going and feel free to chime in. But so I guess we talked about what do we define as small PACE deals. Can you elaborate on what you see as the market opportunity and how are you seeing this show up in the real world? Do you want to go first, Colleen?
I always say that when I started at the previous commercial bank before I was Amalgamated, we started at 250 and we quickly went to 500, then we quickly went to 1 million, then we quickly went to 2 million. So it was very obvious that the mindset at that particular institution was we're doing the same amount of work for both. Why would we go do a $250 or $500,000 deal when we can really spend the time on the bigger ones? Well, that's kind of happened, right? I mean, I think everybody sort of knows that everything is kind of ticked up. But the small balance opportunities are those smaller property owners that really need the help and the guidance. And those projects are, I don't know if I want to use the word hard or more interesting, more complex sometimes, but that goes directly to the heart of and what we do at Amalgamated, which is, again, serve a need. And this is serving the entire market, in our opinion.
So we are a program administrator for the authority, which we've got a servicing agreement. So our minimum's 2 million. And so anything less than that is an exception, which it shouldn't be that way. And then it depends on what capacity your business is, right? So I'm a bank, and so we wear every hat. We are a program admin, we're the capital provider, we're the bond purchaser, it's a bond state in California. We're trustee, we're servicers, we wear all the hats, we're a portfolio lender, so we retain it. We don't securitize these to recapitalize. So that's an advantage, having a nice balance sheet. But a lot of you people are originators or you're part of the transaction. If there's a small balance, so I'm going to keep it at $2 million and below. If it's a small transaction, I would partner with someone that focuses in it, and that's not a bank. It's not a large private equity group. All right, for the most part. All right. So in these situations, I call Colin because he is able to handle these smaller transactions that I can't. And we've got limited bandwidth. So like we were saying earlier, it's the same amount of work for us personally on a $200,000 PACE transaction as it is a $20 million PACE transaction. It's the same process. It's the same underwrite. It's the same pitch and credit committee. And I've got a servicing agreement at 2 million minimum. So that's my situation. And I've always said that the two voids in the industry are servicing small balance, as well as standardization across the states and the authorities. So I hope I shed some light on the seat that I sit in. But I'm going to let Colin go here because I give him these small balance opportunities.
That was a very generous softball.
I mean, you're the guy for that. I mean, I can't. I'm handcuffed.
Well, we're not there yet, but we are laser focused on making it easier and making the process more efficient for small balance transactions, however defined. I mean, it just is like it has to happen in order for this part of the market to scale. That's fundamental. But I would like to just make the case quickly for small balance, because I get why folks move up market. If you're a program administrator or public official, it's pretty straightforward, right? The reason, for the most part, that CPACE policy exists in most states is to upgrade existing buildings. And the cost to upgrade existing buildings, it can be, repositioning buildings can be in the hundreds of millions of dollars, and those projects are important too. But of the 6 million buildings that we've already got in this country, every year, quite a few of them just need an upgrade that's going to cost less than $7 million, usually less than $3 million, frankly. So it's a big part of the market. It's sort of foundational to why CPACE exists. Now, if you are a lender or a capital partner, these smaller balance deals have longer duration. Your portfolio will have lower leverage. The average CPACE to value in your portfolio will be lower, and probably you'll have yieldier assets on the whole. So it is a great business opportunity for capital as well to be involved in this part of the market. But the fact of the matter is that we don't yet have the kind of like standardization and some of the gaps we'll get to in a second. Some still exist, some have been addressed, but it's a massive opportunity. The last thing I'll say, and then I'll shut up. So depending on who you ask, the total CPACE opportunity, annual volume, grows to somewhere, and maybe it takes 10 years, maybe it takes 14 years, I don't know, but it grows to more than $200 billion a year in this country. And a big chunk of that, about half, is going to be the $465 million deals like the one in DC, and that's awesome. But half, $100 billion a year, potentially, is the small balance stuff, just straight upgrades to existing buildings. And that's a lot of money. It's a huge opportunity, but we've got some work to do to get there.
Awesome. So we talked a little bit about some of the barriers, but I'm going to give you the opportunity to elaborate on what makes deals harder. And I might start with Colin if you want to address the gap here. But you can also, we talked about, just the transaction size, the servicing agreements, some of the bank constraints. Sometimes maybe the mayor only signs an agreement on Thursday. And so how can you navigate those gaps successfully? And what things are you finding as you're trying to navigate this world?
So full disclosure, my company, FastPace, we transacted with Paul, and we have a partnership with Amalgamated Bank also that we're really excited about because, and they're filling key gaps here. So one thing I'll just note, and I'll go through these 3 buckets here and the small balance gap. And it took a while for me to sort of really wrap my head around. There's not one barrier to scaling small balance CPACE. There are multiple barriers. But when I first got started, so in the early days of CPACE, then Greenworks, now Nuveen, Petro, Space Equity, everybody, now all the big kahunas, they were all doing $500,000 PACE projects. They were working with contractors. They were out there getting deals done. And about the same time, they all moved up market. And for about 4 or 5 years, a lot of the folks who used to have access to CPACE capital didn't. So 4 years ago, when we got started, there was no certainty of execution. If you were looking at yet a commercial real estate project, you couldn't be confident that the capital would be there, even if you had a bankable project. So that's a major problem that both Paul and Colleen are filling. And so now nationally, any program in the country, if you got a strong project, even if it's only $250,000 or $500,000, there's a lender for your project. So that's a big gap that existed. Related to that, worth noting for Alice is here from Pathway Lending, but there are local lenders who are interested in being involved in this space, but they're not like Paul. They're not going to hold the CPACE on their balance sheet for 30 years. They need to know that there's going to be an off-taker for them, and they need to know that there's an off-taker for a $2 million or $5 million portfolio, not for a $200 million portfolio. And so that requires them sort of, moving down the line here. So some of the community lenders need that infrastructure and standardization in place that now exists, but didn't. And then, sort of kind of moving along to sort of something that we're now actively working on is there's not really a standard. So we still have and I'll pick on Tennessee since it's top of mind for Pathway Lending. There are 4 different CPACE programs in the state of Tennessee. So if you happen to be a CDFI in Tennessee and you want to transact statewide, you would have to either partner with someone who could help deal with that complexity, or you've got to get comfortable with the fact that there's 4 different sets of documents and 4 different processes and like 3 different mayors who sign documents on different days so that you can transact. And so one of the things that I think an opportunity for this group and for us to be thinking about, if we want to get to a place where we're not just doing like 4 or 5 deals a month, but we're closing 10, dare I say 100 projects in the same program in a month, we got to figure out how to standardize some of these processes, because we just can't do it if the mayor only signs documents every other Tuesday. So anyway, that's my pitch for standardization. I love mayors. Love mayors.
Gonna get some hate
Appreciate
mail.
every signature. I don't know if that's helpful or not, but.
Yeah, does anyone else have anything to add on some of the barriers?
Okay, so be careful what you wish for. And so when Citizens Business Bank hired me from another bank that also did CPACE financing, I said, I want to own everything. So I don't want to have to submit to the authority once a month through their board meeting to get formal approval. And in doing so, I obligated myself and the bank to add to staff, because there's a lot of cooks in the kitchen, right, in a transaction. And so, I don't have to wait for mayoral signature or the authority to sign. But at the same time, I'm doing just as much work on the backside for a transaction to close. And I think the most prickly part for a smaller balance CPACE transaction is the size of the senior debt. All right, because if this senior debt's been in place for a while and the principal balance is low, and all of a sudden we stack in some PACE in front of them in a tax position that has super senior priority, I think a senior lender is going to tap the brakes and go, well, wait a minute, why should we give consent for debt that is going in front of us? So I think, there's a balance there in sizing small balance as a relationship to the senior debt. I don't know how Amalgamated feels with that.
We are not a program administrator, so hats off. Because I know that the really great thing about PACE Nation Summit is that we're all kind of in the same room and can talk about these friction points. No, we are not a program administrator. We have a very very ambitious and exciting forward commitment, funding commitment with FastPace, and their team has been going out and closing in various programs around the country. And as we know, they're not all the same. They are very different ways. So one of the complexities is kind of navigating the tri-party agreement. Like, I don't have to explain PACE to anyone in the room, but with 3 different parties, with the program and the borrower and the senior lender, and the PACE capital provider, there are things to work out. And so I would say one of the challenges, since the question was, why is it harder? Well, really, those are all the parties that really need to understand and then row in the same direction at the same rate to get to the finish line on the project. And sometimes it's, I was talking to actually an attorney, a PACE attorney last night, who said it's just as hard sometimes to explain to the senior lender as the borrower, right? So all parties really need to be rowing in the same direction, for lack of a better analogy.
I think more and more senior lenders understand it better, right? Rights and remedies aren't any different for you if there's PACE in front of you or not. It doesn't accelerate in the event of default.
Mhm.
The more transactions that happen, I think the more senior lenders are not just saying no, and they're looking at, their principal, the performance of the property owner in the past for their senior debt. So I think it's getting easier to get consent. It's just the sizing, like I said earlier. I don't think you could have, 300,000 remaining on senior debt and throwing in $1 million of PACE on top of it. That's when the brakes get tapped.
I do think, well, certainly I'm banking on it, but I think at some point
Good one.
in the next few years, we're going to start to see more of what happened in Minnesota, and both Amalgamated and Citizens Business Bank are kind of evidence of this, but in different ways. But where the banks and community lenders are interested in originating CPACE, but also in certain cases, the full stack, and then get interested in identifying CPACE opportunities in their existing portfolio, even though they don't necessarily want to hold the paper or be the CPACE lender. As we increase market adoption, I mean, we do run into scenarios. We've had a couple situations in the last 6 months where, like, at the last minute, the senior lender changes their mind, like market it. One of the things that's a big barrier in CPACE for deals of all sizes, frankly, is that just how long it takes to close a CPACE transaction from term sheet to closing. I mean, I was congratulated a colleague at another firm for a big closing recently, and he was like, yeah, it took a year to get that one done. And I was like, just thinking about all the things that can happen in in the market in a year that could, tip the apple cart. So one of the things that's like really important for small balance is like closing those timelines. But when we talk about that, go back to that $100 billion number where CPACE really starts to take off. I think it's when the stage has like 30 more people like Colleen and Paul on it, who are all seeing the opportunity, across their footprint. And sometimes they want to fund the CPACE themselves. Sometimes they don't. Some of them may want to just bundle 5 or 10 million at a time and then sell to an off taker. I mean, we're already sort of seeing evidence of that, but I think if we can get to that place, it will be really exciting.
Yeah, I'd like to understand how, in everyone's position here, what is the longest segment in a CPACE transaction for you? Because when I'm doing the sell and the education and everything, that's not even in my pipeline. That's just stuff that happens all day, every day. And then when you get a deal in the pipeline, we look at it as debt, right? So you're going to underwrite it like a construction loan, which is what we do. And then once we get a term sheet out, personally, we're pretty quick, right? Bond counsel's always on the ready. We're going to get docs out in, less than 2 working weeks. We get our reports in. I mean, once we get a term sheet in, I would say we're 30 to 45 days on execution. It's up to that point that takes a long time, because PACE isn't for every deal, right? So you have to have that conversation with the property owner about, they're going to go, well, why haven't I heard about it? And, why should I do that versus refinancing my senior? And why shouldn't I just get more of this or that? And the answer is, you got to address all of their questions. And then once you answered all of their questions, then they're going to get their attorney or their CPA involved, right? And then you're going to get more questions. And then, so I think the gestation period for me personally is up until the point where we start to get documentation that they want to do it. As soon as someone commits that they want CPACE, we're a go. I think personally, my challenges and hurdles are before that.
Can I ask you a question about
Yes.
that? So one of the things that we've observed is that as the market has matured, lenders serving different parts of the market have different processes. So it sounds like you're doing a fair amount of diligence on a project before you issue a term sheet. But on some of the larger transactions that are really competitive, I mean, I don't know this, but it feels like CPACE lenders are putting out a term sheet more quickly. And so
No, it's
maybe
true.
the total timeline is roughly the same, but where borrowers are being asked to commit is sort of at a different.
Well, I said that personally, that's what
Yeah.
I feel.
I'm curious if others,
No, it's true, because if we put out a term sheet, it's not changing. So we do a lot of heavy lifting up front. So yes, you're right, for us personally, for the bank. You know,
And I would say, like, I always feel not bad, but I always feel like I'm adding to the timeline because I know that capital providers do a whole bunch of due diligence up front to have all the conversations, and then they get to me and I'm like, well, it's going to be maybe 4 to 6 to 8 weeks until I can get county approval. And so I think that's another part of the timeline gap. And one question I just had was, like, from your perspective, does FastPace, Colin, help the banks and the capital providers understand the documents and the different nuances with each state? Does that become more attractive for citizens, or
have to ask them? I mean, our goal certainly is we want the experience for a bank or credit union or whatever. We just, I guess one of our like operating hypotheses is it doesn't make business sense. Well, I guess there are two. One, to be at the scale that we want to see. Let's just say we would all in this room love for there to be $100 billion of CPACE a year. That would be a great outcome. For that to happen, we need a lot more banks and credit unions, community and regional banks active in this small balance space. That's our operating hypothesis. And most of them are not going to hire 6 or 7 people in-house. They're going to have one person who really understands the product. A lot of these banks, actually, that one person handles their whole like sustainable energy, multiple products. And so what we're trying to do, and now we're introducing software and some tools so that some of that complexity you're describing, Holly, is just like smoothed out. So it's like a TurboTax experience. It's like, oh, we noticed you're transacting in Nashville. The mayor signs on Tuesdays. So, here's the docs, and it just kind of like, so there's always going to be some variation, but to the extent that like that complexity, because like, and this is why I have the small balance, put that on there. Something that I just didn't know about the world is how the part of the job that Paul and Colleen have going to their credit committee, and that there are bank examiners and there are people who are stakeholders in the PACE industry who aren't at this conference, who are looking at these PACE deals and being like, explain to me why we should put this on our balance sheet. Explain to me why we should make an exception on this particular deal. And so our job is to try and streamline that and make it as vanilla ice cream as possible so that it's easier for Paul and Colleen to go to those folks who I've never met and make the case so that they can close their deal.
Well, I'm going to talk about that in the banking breakout session. So at Top of House, we classify PACE transactions as a C&I transaction. So we don't have to hold as much Tier 1 capital for construction use type of PACE capital. So we like it, right? We don't have to hold 1.5 times like we do a construction loan.
I'm sure that is going to be a hot topic on the banks panel, which we Amalgamated will be on as well. But I would say this, that it's a tough question because there are so many complexities that vary from program to program. It would be a dream to close in the same program like again and again and again and again. Because there's so much opportunity. And I point to North Carolina and Arkansas, like brand new programs that have just opened up. Like how do you know, there are nuances, but it's like when anyone from this room runs into someone from your family or on the street and they're like, PACE, what does that stand for? Property is that, and then you go to explain it. It takes like a second to explain it. And I would say that there are certain commonalities among all programs. You always have to have a PACE energy. So you always have to prove out the energy savings. You have to have certain frameworks in place for every single PACE deal. But there are nuances between what is eligible. One example, but the legal documents and the frameworks are very much common between the programs. So it's really, you have to get pretty sort of technical to, you know, and only if there's kind of an issue with a project, where you have to kind of stop and explain, you know, all of that to a lender. Otherwise, it's a pretty, you know, you're always going to have the lien. You're always going to have underwriting metrics that you're underwriting to, for example. But it's, you know, I guess the more you do it, the better you get at it. It's the bottom line.
So shifting gears, we've talked about some of the barriers or some of the nuances to small PACE deals. Talk about getting deals done. And so what are some solutions? I'll just share personally. We got a credit union to come on board by sharing our documentation. So they leveraged our PACE agreements, and then we assigned them to them. So through that, they didn't have to, you know, eventually they found their own legal, but they didn't initially make any investments. We helped them set up the program. And then when they saw how it worked, they've done over 100 different deals in the state. And so that was one way to get them on board. We've also, you know, packaged together some ESG loans and then sold them to, you know, increase our revolving loan fund. So we've talked a little bit about standardization or underwriting, but what are other things that can move programs forward? Or if you want to share a success story,
that's my favorite.
Get into
topic.
that.
Talking about projects is my favorite. I love talking about the Martyr Seafood deal that we closed on the FastPace platform last year in Massachusetts, because we were number 4, I think, there, and it was a very pure play, what we call, you know, as an existing building, and they wanted to add solar and wanted a solution for that, but again, hadn't really heard of this until it was brought to their attention. And then there's a senior loan. There's a senior lender that needs to be educated as well. And it was a great execution when we got it done. But it also required a lot of being a registered capital provider. Took a minute, and there's some, you know, some reasons behind that. But the other project I love talking about is a fully retroactive deal in Nashville, Gallatin, and that was essentially reimbursing a developer for full gut rehab. Everything really was energy efficient in that project, and it was retroactive. So they had the opportunity to go plow that into another project. And this is a kind of a local brand that was beloved locally. And they, you know, again, small property owner, you know, quite the opposite of like the $500 million deals. Those are really the projects I really love working on.
Yeah, the retroactive, I think, is great for small balance. A lot of people don't know that they can be recapitalized, right? And if the capital provider approves that, you know, the, you know, cash flow can service the additional debt, you can go, here you go, and they can reinvest somewhere else. I think with small balance, retro is good, very good.
I guess I'll just, how do you pick a favorite child? It took a long time, but I'll say we have closed over the past, like, little over 2 years, 27 projects, but 3 of them in the last 8 days. And another one next week, and another one the week after. And so things are starting to pick up. Our largest deal size to date is 4.6 million. That's we've done. The smallest 200,000. I would say I'll get the numbers wrong a little bit, but maybe of those, maybe 7 were lender originated, a CDFI or Green Bank, identified the opportunity and then used our platform to transact. And then the other 20 or so we originated. At the end of the day, just, small plug, we see ourselves as infrastructure for scaling this part of the market. We don't ultimately see ourselves as like an originator out, at scale. We want to be, there is that component of it, but just building that infrastructure so folks can scale. And I mentioned that to sort of just because I want to highlight a couple folks in the room. Bricker Graydon, I want to give Caleb a shout out. Is Colin in here too? Colin Calvis. Asset Environments is in the room. I think Amerinat is here. So part of the infrastructure that we're talking about is like the third parties that also have to be willing to get these small balance deals done. We got a deal done with Texas PACE Authority. And so it takes a lot of different folks to sort of agree that it's worth doing. And so just want to give a shout out to the folks who helped us get the first 27 done.
I would share that I have a local bank that has, I think they have, 6 or 7 PACE deals in Minnesota, but they were utilizing FastPace platform because they don't know the laws in all the different states. And so they were utilizing your company to expand their scope outside of just Minnesota.
We were very excited when they told us that.
Yes. No, Andy, well. And so, there are different constraints. Every statute can't be changed. We can't standardize or simplify and everything. But is there any other things that can help scale? And I think what I'm hearing is like rinse and repeat, as much standardization as possible, just getting the word out, partnering with a bank, having your champions right here. Is there anything else that you can add?
I'm talking way too much, but I would just say getting deals done. We learn every time we transact, we learn something.
So true.
And you just getting more deals done. And like one of the things we're working on now is like building a baseline data set of performance data for small balance and like the lower middle market CPACE. Like there are folks who just won't get involved in this space until there's more data. And so if you've got deals out there that are bankable deals, call us up. There are folks who want to get these projects done. And I think that just getting more reps is going to help us scale.
Absolutely.
I would just say the new programs as well, programs just coming online, also want to get the word out. And often it's, an economic development person or a city council member, someone that they have a job also, and they're doing PACE as well. So I think the more projects that get closed in these new programs as well is very helpful to the overall market. So you're a very mature program, and you are extremely helpful. And we closed a deal obviously in December with you, and that's exceptionally helpful too, is having that program administrator alignment with the lender, aligned with the borrower when everyone's rowing in the same direction.
And I think what I'm hearing is that really the benefit is closing the deals grows the income and the benefit as well for investing in that. Colleen, do you want to expand a little bit too, just on the personal aspect of it? And like, we're also making a huge impact on just the carbon footprint with these smaller buildings as well.
Absolutely. I love talking about projects more than anything. And it's very exciting that we closed a deal recently here in NYSEG's program. And it was an electrification of a transitional housing. And it was really a huge human element to the project, as well as obviously the CPACE is coming in to finance that electrification work. But honestly, every project we work on, our chief of sustainability reached out to me last night and is looking for more. We report on financed emissions and a lot of our sustainability reporting, and CPACE goes right to the heart of all of that in terms of mission. So I do love talking about projects, and I could talk about those all day long. But there's very much a human element in the small balance CPACE world as well that is very meaningful to us.
What was the selling point with that project? Why did they want PACE?
That was actually a expensive, in the case of the city, it was an expensive mezz it was too expensive. The
Yeah.
mezz was just outsized versus the market, and it was important to pay that off and bring the cost of capital down, and keep that. It's a nonprofit that is master leased. So there's, we're not saying like out loud who it is, but there's a huge social impact in that project as well. But it was paying off mezz and lowering cost of capital and allowing that owner to continue what they're doing. Right.
Yeah. I think nonprofits are really more open-minded about PACE. And I also think family office is pretty open to it too. Generational wealth, like the prepay is not going to kick in, right? They're just going to hold it. It's long-term fixed rate. In California, it's a semi-annual payment, right? So if there's any cyclicality in your revenue stream, it may be a little easier to manage that type of product for that. So, and then nonprofits, we just will hand bill them versus the tax collector collecting the PACE assessment. But we underwrite it the same. I mean, they're not tax returns, but company prepared financials. That's what we kind of use on our approvals for nonprofits. But I think nonprofits are really more open-minded in family office.
Yeah, I was going to say, are there any audience questions? I saw Jonathan first, then we'll go to Deb. You can shout, or there's microphones behind you as well. I think the microphones would just be, if we're recording, they would then pick up your question.
For the recapitalization, when PACE comes in after the fact, that's retroactive, are those planned ahead of time? Or is that more kind of opportunistic, where you have a problem with an existing loan? I can swap out PACE for it to make it easy.
It's mostly, I would say, super majority is opportunistic. There are some that say, hey, we're going to put the capital in now, and we know we can go get PACE later for recapitalization, but we're not sure on who the takeout lender is yet. So that is a strategy, but it's a smaller bucket. I think it's more opportunistic that someone didn't know that existed. The program existed to do that.
And a quick follow-up, is the capital provider for the takeout the same as the senior lender because they're the ones seeing the problem, or is the capital provider for the retroactive financing a third party?
Can you repeat, please?
So senior lenders can also be capital providers.
Yes.
Right.
Mm-hmm.
So on those retroactive deals, are you finding that the senior lender is also the capital provider because they see the problem?
No.
The capital provider, a third party entirely.
Yeah, I think it's new. I think it's not the same. We do have an integrated financing solution, so we can do the senior plus the PACE. And then sometimes, depends how good the project's doing, but we'd like to see, a year of actuals before we do the recapitalization if we are doing the integrated piece. But mostly it's a third party that I see. Yeah. Including us being that third party and partnering with another senior lender.
I've heard said many times that small balance projects are riskier than large balance because large balance you have more sophisticated owners and professionals supporting the transaction. So either support or dispute that that's out there.
It's an interesting rumor.
Yeah.
But I can understand why people would kind of jump to that assumption. But I think it's an education right? It's an education of the borrower and the sponsor team through and through, the legal representation of the borrower, the borrower themselves, and then obviously the program is helping with that conversation too, as I know you all do. But it's very important that they understand every element. But to honestly Paul's point, we underwrite to a pretty a bank standard. So our underwriting is going to cover in terms of like the actual cash flow and the LTV, all that is going to be top of mind before you even get to the closing table. That's all done.
The strongest indicator on day one of the strength of a small balance deal are not the financials, it's the strength of the sponsor, the property owner. And so it's like the first thing that we look at and really want to understand is like, who are we dealing with? And so that just as part of the underwriting, as Colleen said, that is like with a bullet kind of at the top. And then the second thing I would say, Dub, is like, that's why, and I think we'll be making maybe an announcement about this later, but like having performance data for this segment in particular is going to be the only way to push back on that these are just like sort of inherently riskier. And that's going to take us a few years to have like the breadth probably of data that we need to have that's seasoned enough that people are like, oh, these actually, that's not the case. Because when you look underlying, these are lower leverage. Like, yes, they're smaller, but like Martyr Seafood, this is not a 35% pace to value deal. I'm not knocking higher leverage new construction deals, just saying that like, if you actually look under the hood, it's not obvious that it should be riskier. It's just like, I just don't know how I feel about, smaller projects. So the data, I think, is going to ultimately tell the story there.
I think the smaller balance with the educated property owner, I think it's you're going to the side of it not being above board and taking advantage and that sort of thing. I think that's happening less and less and less now because the product funds more and more units every year. Education's out there with senior lenders. Property owners are starting to hear about it more. I've been in it, 7 years? I've been a lender for 30, but over the last 7 years, it's exponentially grown. And there's less education I need to do and sit down with the property owner because they have heard it or someone told them about it. And you're just filling in the gaps now instead of, what it used to be like.
We're just about out of time. Mary, I'll let you ask your question quick and then.
So you opened with that Minnesota is different than a lot of other states because you're a port authority, you do bonds, you have the revolving loan fund. But you also said you closed 7 projects with fast pace. How did those two things intersect?
Just to clarify, so yes, we can bond, but we haven't. Our success is really that $15 million revolving loan fund that we've revolved 4 times. And we haven't closed a deal with Fast Pace yet. But one of my bankers who we have deals has gone to Collins Group to expand nationwide. So he knows how it works in Minnesota, but he didn't know how it worked in Michigan. And so
it's
Collins,
a bank that's doing
yes.
projects in other states.
Yes, yep,
Oh.
yep. Well, I just want to thank you all. First one done. I really appreciate your time and attention, and I wish you the best rest of your conference.
Thank you.
Thanks all.
Thanks, everybody.
That's great.